How does a market crash affect equity mutual funds? Industry expert Amrita will explain this now.
I'm showing you AMFI data of mutual funds of India data, and that is basically looking at the P ratio, price to earnings, which is for every 1 rupee earnings of a company, how much price you're willing to give to acquire that company. And it is also a reflection of the market. And we have seen whenever P ratio have lowered or markets have crashed, money into equity has become negative or it has become very, very low. So usually the adage that buy low, sell high. So you should buy at low P and sell at high P. It's not happening. So the average forward P ratio is almost 18 times. When the P ratio turned 12, 14, 4, it is like very good levels to invest incremental amount. But it is like buying a Rolex watch, which is worth multiple lakhs and few thousands. But not a Burma Bazaar Rolex watch, a proper Rolex watch. But we don't want to buy it because we are so, this kind of negativity is totally affected our psychology.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.